Welcome to This Explainer. Today we're going to put on our financial detective hats and uncover some hidden, frankly kind of scary systemic risks that are currently brewing inside the massive private credit market. Because look, while everyone is totally distracted by sky-high stock prices and, the latest AI hype, there is a completely different story quietly unfolding in a massive $2.5 trillion asset class. Cracks are forming, the pressure is building, and the silence around it, well, it's entirely by design. So let's just pull back the curtain right now and see what's actually going on.
Okay, so let's dive right in by looking at the 30-year Treasury yield. Recently, this yield spiked to over 5%. We're talking about hitting levels we literally haven't seen in nearly 2 decades. And if you're sitting there thinking, okay, who really cares about Treasury yields? Well, you should, because this number represents the baseline price of money. It helps determine the borrowing cost for trillions of dollars of debt all over the globe. And what's truly alarming here is that the US isn't alone in this. We're seeing global bond markets in the UK, Germany, and Japan all flashing these exact same warning signs. You see, the bond market is supposed to be the adult in the room. Boring, stable, predictable. But right now, that adult is quietly pulling the plug on the whole party. To figure out why investors are quietly freaking out about the price of money, we first really need to peel back the layers and understand the basic mechanics of bonds, because the number you're seeing in the headlines is just a symptom. So the absolutely crucial point here is that in its absolute simplest form, a bond is really just an IOU. It's a piece of paper that promises to pay back a fixed amount of money at a certain date. People bid on that paper, and the price they're willing to pay determines the yield. And here's the kicker. They have a totally inverse relationship. If buyers are just scrambling to buy, the price gets bid up, and the yield naturally falls. But if buyers aren't interested, the price drops, which forces the yield up. Meaning, when yields are rising across the board like we're seeing right now, it tells us that buyers are demanding a much higher return before they're willing to lock up their cash.
And there are basically 4 underlying macroeconomic forces that cause these buyers to just step away, forcing those prices down and yields up. First, the Federal Reserve sets the baseline rate. So if they hike rates, older bonds with lower rates instantly lose their appeal, so their prices drop. Second is inflation fears. Investors want more return up front to compensate for their dollars losing purchasing power over time. Third is just massive supply. The U.S. is issuing literal Costco-sized amounts of new debt, and eventually there just aren't enough eager buyers to soak it all up. And fourth, you have dropping demand from major institutions, like foreign central banks or pension funds, who might be, sort of doubting a country's long-term fiscal health.
But actually, here's where our investigation takes a real turn. The real story isn't just government bonds. The actual danger is lurking off Wall Street in the massive, booming world of private credit.
To understand this, let's look at the short end of the yield curve, specifically a benchmark called SOFR, which stands for the Secured Overnight Financing Rate. You can basically think of this as the overnight receipt for the entire U.S. financial system. It's not some projection or guess, it's a hard number published every single morning based on actual cleared and settled trades. It tells the market what overnight borrowing actually cost the day before. And SOFR is absolutely crucial because it's the benchmark that heavily influences this massive private credit market.
Now check out the incredibly aggressive rate shock borrowers just went through. Back in early 2022, SOFR was effectively sitting at 0%. Free money, basically. Then the Fed started hiking rates to fight inflation, and by mid-2023, SOFR shot up to over 5%. Even with some of the recent rate cuts, it is still sitting significantly higher than it was before the pandemic. That is an incredibly violent move for the fundamental cost of borrowing.
And this brings us to what we call the floating rate trap.
This aggressive rate shock is devastating because the vast majority of private credit is built on floating rate loans. Unlike a fixed-rate mortgage where your payment stays exactly the same no matter what crazy things the economy is doing, a floating rate loan is pegged directly to a benchmark, almost always SOFR, plus a little spread for the lender's risk. So when SOFR goes up, the borrower's interest payments go up right along with it. We can clearly see the fatal consequences of this in the real-world case of a software company called Pluralsight. In 2021, they were acquired by a private equity firm, Vista, and took on over $1 billion in new private credit debt. Because SOFR was near zero back then, the math totally worked. But as we just saw, SOFR spiked to over 5% across 2022 and 2023. Pluralsight was suddenly drowning. By August of 2024, their interest payments became so completely unsustainable that their lenders had to step in, inject new money, and seize 85% equity control of the entire company.
Now, if borrowers like Pluralsight are going under because of this massive rate shock, you'd think alarm bells would be ringing everywhere, right? But the finance industry is insisting everything is perfectly healthy.
Welcome to the sneaky accounting and cockroaches phase of our investigation.
During an earnings call, the CEO of JP Morgan, Jamie Dimon, dropped this highly memorable metaphor when he was asked about potential cracks in the credit market. He just said, "When you see one cockroach, there are probably more." And honestly, that perfectly describes the reality of the systemic, unseen risk brewing right under the surface. Pluralsight wasn't some unique, isolated failure. They were just one borrower in a massive stack of companies that absorbed that exact same compounding rate shock.
And the data absolutely proves these cockroaches are already emerging. Just recently, the Fitch private credit default rate, which tracks more than 500 middle-market borrowers, hit a record 6% on its trailing 12-month measure. 6%! This is literally the highest rate recorded since they started tracking it. So make no mistake, the distress is very real and it is actively happening right now.
Okay, so if defaults are hitting records, why hasn't widespread panic set in yet? Well, the reason is a sneaky, frankly almost absurd accounting trick called a PIK, or payment in kind. Look at how wild this illusion is. Step 1. The borrower can't afford their new higher interest rate and cannot pay in cash. Normally, boom, that's a default. But instead, in Step 2, the lender just flips the loan to a PIK. This means the unpaid interest is literally just added to the principal balance of the loan. Then, Step 3, and this is where it gets crazy, the lender actually reports that unpaid, uncollected interest as income on their books. And Step 4, because many of these funds operate as business development companies or BDCs, they're legally required to distribute 90% of their taxable income to keep their tax-free status. So they literally mail out real cash dividends to investors using imaginary income they never actually collected. A company sliding straight toward insolvency suddenly looks like a perfectly healthy income-generating asset on a spreadsheet.
And let me be clear, this isn't just an isolated one-off accounting loophole. The usage of these camouflage features is spreading rapidly across the entire private credit industry to mask all these distressed borrowers. PIK features have jumped over 72% since the end of 2021 alone. They're now baked into 11 to 12% of all private credit loans. Some funds are reporting PIKs at over 14.5% of their total investment income. And the real kicker here? In a recent month where Fitch recorded nearly double the average number of defaults, over 60% of those defaults involved the introduction of payment-in-kind interest instead of actual cash. The cockroaches are multiplying, but they are just being aggressively swept under the rug.
Furthermore, there's a whole other layer protecting this illusion. Because these private middle market loans never trade on a public exchange, there is no active public market price to look up. So they're often classified in financial reporting as Level 3 assets. This is the absolute most illiquid and subjective category of asset measurements out there. It essentially allows funds to value these loans completely subjectively, using their own internal models rather than facing the harsh reality of open market data. It's basically grading your own homework.
But here is where the rubber finally meets the road. All these tricks, they're heading straight for the maturity wall.
Between 2026 and 2029, a staggering $85 billion in BDC loan maturities will come due. Think about that. When that time comes, all of this massive debt that was originally secured in a near-zero interest rate environment, will have to be refinanced at today's brutally high rates. The can has literally been kicked as far down the road as it can possibly go, and very, very soon, someone is going to have to face the music.
Look, you might be able to hide a loss on a spreadsheet for a little while. You can roll unpaid interest into a bigger principal, and you can even label a highly distressed borrower as a perfectly performing loan. But at the end of the day, the math is still the math. So I want to leave you with this final question to consider as this massive $85 billion maturity wall approaches. What happens when the bad math stops disappearing? Thanks for joining me for this explainer, and definitely keep your eyes on the data.